Welcome to the Live Squawk podcast, where professional traders, investors, and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary. Hello, and welcome to Live Squawk's Financial Market Podcast on Friday, the 17th of April, 2026. Every week, myself and guests break down the key stories of the week gone and look at the implications for the markets. We'll also preview the week ahead, providing you a heads up to what you should be looking out for. This week, I'm joined by Jamie Dutta, market analyst at PIQ, and Mike Zaccardi, financial writer, storyteller and teacher, self-professed storyteller and preacher. He might be a preacher as well, focusing on investments and markets. I'll bring you both in shortly, but before I start, just a quick disclaimer. The content provided on this channel is for informational and educational purposes only. We're not licensed financial advisors, and none of the information shared should be considered as financial investment or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We're not responsible for any losses or gains that may result from following the content on this channel. Hello and welcome to you both.
Morning. Hello.
Again, Mike's in North America and Jamie is in the UK. So if you say here morning and good afternoon, that's the reason why. And timelines are important because in the middle of writing my scripts, I had to rewrite my scripts because of the ongoing news cycle that we have at the moment. And so this is what we had within the last couple of hours. We had a Truth Social post from US President Donald Trump saying the Strait of Hormuz is completely open and ready for business and full passage, but the naval blockade will remain in full force and effect as it pertains to Iran, only until such a time as our transaction with Iran is 100% complete. This process should go very quickly, that most of the points are already negotiated. Thank you for your attention to this matter, President Donald J. Trump. And that came out at 9:27 a.m. local time. And the markets got it here in timely fashion, just ahead of the cash market open stateside. And we saw the energy markets plunge some 10% with stocks jumping out of the cash open after Iran's foreign minister as well was on the wires and said that the Strait of Hormuz is completely open to commercial vessels. Trump, as I said, posted on Truth Social a little while later that the US's naval blockade on Iranian ports would remain, though, in full force. Which absolutely ripped up my initial script that was going to talk about the 10-day ceasefire between Israel and Lebanon, in effect, with Hezbollah, basically. And this alongside an extended ceasefire between the US, Israel, and Iran. But as I said, that was the old script. This is the new one. And I want to get some initial reactions based on what we've seen in the markets, and subsequently we'll be talking about it anyway in terms of equity markets and how buoyant they've been. So I'll come to Mike first. Mike, what do you make of what we've heard in the recent few hours, I guess, and its effects on markets?
Yeah, well, as opposed to some previous announcements, this one just seemed more anticipated by the market. I mean, the S&P 500 rallied, 12% coming into today. Futures were already higher before the Truth Social post, and they'd been rallying through the morning and then took a little leg higher after that. So, it wasn't as explosive as a move. There's certainly no signs of sell the news at this point. We have the S&P 500, 71.25, all-time high. We have the ACWI, also record high, best 3-week rally back to June of 2020 for global stocks. So this appears to have legs. Obviously, the kind of quirkiness of it and what folks are still unsure about is, why are we so much higher now than even before the war started? When, really, what's now changed versus 6-7 weeks ago? But, it's one of those things where, you may have to take off your macroeconomics hat and put on your market hat and realize that, this is just another one of these battles that stocks have encountered and come through on the better side of along with corporate management teams who are now, I mean, you can go back to COVID and find so many of these sort of macro shocks and curveballs that executive teams have been able to weather
Mm,
quite well so far. I mean, just look at global profit margins, especially in the U.S. So when it comes to the Strait of Hormuz issue now, I mean, we'll see exactly how many ships actually pass through over the coming days. I would imagine between now and Sunday night, when the U.S. futures open, there's going to be more headlines, more uncertainty. But volatility readings looking ahead are much more subdued now. We have the VIX is below 18. Shorter term volatility measures are even below that. So I don't know. We'll see how many headlines we get over the weekend. If there really aren't a whole lot, uh, then analysts will go back to focusing on the earnings season, which is now in full swing. So there will be other things to look at.
mm.
And over the US, we'll get retail sales too. So I don't know. Is this a one and done thing? Probably not, but certainly, both sides have an interest to have the strait open at this point, and certainly over stateside, we're getting closer and closer to the election. So I don't think President Trump wants to upset the apple cart too much.
No, no coincidence, maybe. So you, in your, to sum it up, you say this is a learned experience in terms of we've been here a number of times now with different crises, and the market's better prepared and better focused on what matters. Hence, why we've seen some of the price action potentially we've seen at the moment, and less of the more fatalistic sort of moves that would have maybe been seen 2, 3, 4 years ago.
Yeah, for sure.
Mm,
Um, Oftentimes it takes uncertainty and a fear factor for markets to actually go higher, and the old wall of worry issue.
yeah.
So that seems to be a pretty classic situation. And I mean, the V bottom this time was as intense as we've ever seen. I think even though the drawdown was less than it was obviously during COVID, and then during the post Liberation Day swing, the rally, the snapback this time was as intense as any, which is pretty incredible.
Fair enough. Jamie, what are your views on what you've seen over the past week? There's not just focus on today. Today is obviously important. Um,
Yeah.
Again, there's another True Social that says Trump has talked to just update everyone at time of listening. I think President Trump's been speaking again and basically said, what's he said this time? Has agreed to never. Trump says Iran has agreed to never close the Strait of Hormuz again. True Social post. So yeah, interesting. Anyway, sorry, Jamie,
Yeah.
you were saying.
Yes. Interesting what Mike was saying. I think that the Strait of Hormuz was, open for commercial shipping. I think there was the foreign minister when, I was sitting watching everything, and you could tell that WTI was selling off stronger than crude at the time before the
Mm,
announcement. Literally, you were probably watching the same. And then the foreign minister, I thought, came out before then Trump came out. So I was kind of wondering whether you might see something to sort of conflict against what the foreign minister was saying. He did then say that, then Trump obviously backed it up. And I think the Strait of Hormuz opening sort of, obviously in the price, but I think that's quite a surprise in a way. And that's why we're seeing, pretty decent reaction, even above the reaction that we've seen this week. For me, I think this week it was all about, if there's no escalation, then that was obviously a huge positive for the market, and that's what it was taking. And the market was definitely half full, as we've seen. I think Mike touched on sort of earnings, and valuations, and those that being a big driver, I think, of stocks, especially with earnings revisions, and then obviously with that price sort of move that we saw lower, that basically means obviously you get better valuation metrics. And that's what's helped stocks obviously into earnings season as well. And then positioning, I think, really is huge for stock markets and indices, right? Because we had the classic sort of de-risking, lower sort of active risk, if you like, back to sort of benchmark allocations, and then now normalization of sorts, better than it was, as I say. And I think that's all relative and very important. And then now re-risking, and I think, yeah, CTAs have been re-risking, short covering as well. And then you've got, by all accounts, big call buying, and that's just going to extend this move, where dealers are basically chasing it and then pushing it higher because they have to. Whether we're now sort of somewhat overextended, overstretched, with a sort of crowded upside squeeze, I think we get, the FOMO sort of rally that we've seen in a way because people are expecting something positive to happen. I think, that sort of sentiment change obviously happened this week.
Sure.
If you look at the NASDAQ, we're up 13 days on the spin. We've not seen that, I think, since '09, or at least 12 days. So that sort of upside momentum, we're overdone now. So sort of support is now the previous record highs, in the NASDAQ and the S&P at least. So, fascinating. What can you say?
Well,
Otherwise,
just quickly, just sorry to talk over you.
yeah.
The Bank of America's flow show had an interesting point, made an interesting point in their weekly flow show. They said the biggest picture, nothing says risk on more than Aussie dollar cyclical FX at its highest level versus the Japanese yen funding FX since October 1990. It
Yes.
kind of maybe tells you everything you need to know about where the market is facing at the moment, potentially. Jamie, Mike, did you?
Yeah.
What do you make of that fact from the Bank of America?
Yeah, Michael Hartnett likes to look at the currency aspect of some of these moves, but I think we have to keep in mind that over in Japan they have kind of a unique set of circumstances now versus a decade ago. I just don't know if the yen is as quite of a risk off barometer as it used to be, just with the fiscal matters over there. So I mean, I think we should anticipate um, you know that level of yen weakness, given what they're kind of embarking on. But I mean, you can't ignore um, the signal from from some of the FX space. I mean, we can zoom out big picture, look at the dollar. It's now at a lows going back to February, so it's also round tripped the war move. So just another sign that the swing in positioning has been fast and also wide reaching across asset classes.
Yeah, absolutely, very good point, Jamie. I think you might have.
Yeah, sorry, I cut out there. Yeah, I'm back. I'm back on it.
We were talking about the Bank of America flow show,
Yes.
and the fact that part of their report said that nothing says risk on more than Aussie dollar cyclical FX at highest level versus Japanese yen funding FX since October 1990. And Mike just caveat that by saying, look, you have to look at the situation in Japan at the moment and what's going on there from a fiscal perspective before jumping to too many conclusions about that big picture.
Totally agree. I think Aussie yen used to be a great barometer, risk barometer, wasn't it? Classic. But now sort of slightly less so, as Mike said. So I totally agree with that. Yeah. But obviously an interesting pointer, to where we are generally. With sort of tail risks fading, and the best way to see that almost cleanly, to see the relief trade, obviously equities, and then those sort of risk on, risk off currencies, although, as we just said, yen slightly different now.
Yeah. Okay. I want to move on then. Again, looking at the past week, really, which is almost irrelevant, but not really, because looking at the bigger picture, we were pricing in hikes for a number of central banks. Specifically, we're looking at ECB. We saw the ECB minutes out this week, and I've written here: investors now expect 2 hikes this year. A number of analysts have actually moved their hikes. I think I've got a note here from was it policymakers? Yeah, we've heard from a number of policymakers this week. Quite a lot of ECB policymakers, and it kind of moved the dial on where we were looking for these hikes to come this year. ECB's Muller speaking, I think today, said cannot fully exclude move in April, which stands out as a particularly pertinent comment. But we also have from ECB's DeMarco saying that June was a more natural time for judgment. I step back and see where we're at. Then obviously we've got a fast moving situation around this Middle East crisis. Therefore, the spillover effects, second round effects from high oil prices that we've seen, even for this 6-week period, how much is that going to be permeate into everyday prices and price of a basket of goods, which is the the conundrum and something that the central banks have to look out for. I've got a note here from JPM's Greg Fuzesi, says that on the likely timing of future hikes, that his bank had pushed back its call for 2 ECB hikes from April to July to June and September. From April and July to June and September, saying that uncertainty is still high as the situation in Iran Hormuz remains unclear, and any resumption of shipping will take time. ECB communication has not helped, as it has not clearly linked ECB staff scenarios to likely policy actions. Based on current energy curves, risk is likely skewed to more modest tightening. And obviously, even more so if this comes to fruition, and we do see this cessation in violence actually last and turn into a deal which President Trump promises is coming in the very near future. That leads me on to the Eurozone March CPI. We saw sharp gains in that March reading already. Jamie, on the ECB and what we've just heard and the latest figures, do you throw that out now with the bar fought out and just wait to see what happens in the next week on the geopolitical front?
Yeah, very much so. I think we've talked about this before. I think last time I was on, actually, and I grabbed my notes from that time, and it was when the ECB meeting was going to happen along with the Bank of England. It was whether they were going to hike then. And we sort of talked about, the bar being quite high because rates were sort of sorry, I'm just looking at my notes. Actually, the bar was quite high because tightening into supply shock was sort of rate credibility risks than extending, into prior sort of easing cycle. So I think for the ECB, again, they're sort of scarred by history and their sort of credibility, and then wanting to sort of emulate. I think this is a big factor, sort of even the Bundesbank from way back, So they obviously, I think, very important, they're single mandate rather than dual mandate, and obviously the Fed, so very different to that. So the focus obviously on inflation, but I think they can wait and see, and you've even seen that with some of the comments this week. Lagarde, Schnabel, just sort of slightly more hesitant and not rushing to a decision. I think that is probably key for me. And as I say, Lagarde, I think another official, Schnabel as well, all this week saying similar type of things. So the sort of how many hikes do we have at one point priced in? 4. I mean, quite incredible. Now we're down to sort of 2, I think, for the year. Very little chance in April, I think, which is for me very, is correct. And whether now, people are backing off from, if they have to hike, they have to do 2 because it's got to mean something. And, the one is none sort of theme doesn't really hold. But now there's that change again. And I think we'll probably see it next week if everything sort of pans out as President Trump hopes, then, do we even get the 1? We may get an insurance hike in June, but they've still got a fair bit of data to go, even pre-April, I think. I'm just checking what's about. Yeah, they've got GDP, April CPI as well, and then the consumer survey, the ECB's consumer survey with inflation expectations. But finally, I would just say one point as well, long-term inflation expectations still around 2%. Right, so the 5-year inflation swaps, 5-year forwards, 2.1%. So, do they need to act? Maybe if the core goes to sort of 3.5. But at the moment, we shall see, and I'm sure that is what they'll do, and wait and see.
Yeah, Mike, do you have anything to add on this, even more generally than the ECB? But again, this core versus the headline numbers for inflation. Core has remained relatively stable, so and expectations in themselves haven't run away, as we just heard from Jamie there. Do you have any views on where central banks are at the moment in that respect?
Yeah, I mean, over in Europe, it's very interesting because, of course, ECB has the single way mandate on inflation, and so they're naturally going to be pretty spooked by Brent's trading close to 120 and TTF gas up near 60 euro megawatt hour. But both of those obviously come way off, and We see it right now. Like I'm just looking at the German 2-year yield. It's now printing 2.4. That was 275 as recently as a couple weeks ago. So, that's uh, down sharply. And I think, we're even looking at much lower rates over in UK. I mean, 20 basis points down on their 10-year today. That's the lowest going back to middle of March and almost before that.
Yeah, I think that was far more volatile. The UK particularly was being hit hard by all of this, I think. So I think there was far more for it to go in terms of coming back to a more settled point, I guess, on that front, because it's
We've seen that in fixed income markets, right? Sorry, Mike, and but sitting here watching gilts constantly for years and years, right, Harry? The moves are always overextended in gilts. It seems like in gilt yields, always overextended. So downside or upside. So, and that's what we've seen. And I think, sorry to interrupt, but the just this idea as well that the UK is facing more of a severe inflation shock than elsewhere. That's what we saw with that big spike in 10 years in gilts. But then in fact it's natural gas which is the issue for the UK, which sort of a lot of market participants, I would say, gloss over, and natural gas really isn't a crisis here. So yeah, I think that's quite an important point to bear in mind.
Sorry, Mike, you were saying.
No, that's good stuff. You were mentioning inflation expectations, and those have been pretty stable, especially over here stateside. And we saw that in both market-based measures as well as some survey readings. So, everyone's kind of looked through this, which at the moment appears to have been the right thing. We're talking about European gas. I mean, that's, I think, now back below 40 euro megawatt hour. And we've got over here June oil under 80, and that'll become the prompt month middle of next week. So things appear to be normalizing on that front. And ultimately, when it gets back to our central bank discussion, that should tap the brakes on the extreme hiking outlooks that some are calling for. So it'll be a very interesting meeting ahead for the ECB as to where they see things stand now, with just so many changes one day after another here.
Dare I say the word transitory?
Let's bring it back.
No, let's not do that. What I would say is this is, in terms of for short-term traders and intraday traders, we're getting back to the days we've not seen for 15, maybe 20 years, where you've got a rate decision coming up and you really don't know potentially whether we are going to see a move or not. It could be that they've seen data and they've seen something in the data that they're worried about. I doubt it, but they potentially. Hence why we've seen people start to talk about April, and I know others have started to price it out. But again, we're coming into a period, I think, over the next 2, maybe 3 events for central banks where, the scale's going to be tipped one way or the other in terms of what that bleed over effect has been, whether that's on the damage to demand or whether there is a level of inflation that they want to get ahead of. So, again, interesting on that point. Just to quickly go through some of the other bits and pieces we've had out this week. UK Feb GDP, surprise acceleration was only half the story. We had GDP data out that showed a 0.5% rise in February for headline growth, which, as good as it is a backward-looking measure, and therefore, in reality, this came in. I mean, the war started, I think, on the conflict started on the 28th of February, so right at the end of the reporting period, and therefore wasn't captured within economic activity data from the Office for National Statistics, the UK Stats Office, and therefore we got the rise. Underlying that, Jamie, we did see some promising signs, didn't we, for the UK economy?
Yeah, I think so. I mean, I'd agree that it's backward looking and, is a lot of noise. I think that there is a sort of seasonal nature as well, isn't there? I think one of the banks highlighted, back to 2022, where Q1 is always much stronger than we start off really well. And then the rest of the year fades away slightly.
I can tell you that was ING, basically. James Smith of ING says, if it sounds too good to be true, then it probably is. That's our initial reaction to the apparent surge in UK GDP in February. It's consistent with a pattern seen since 22, where growth has tended to come in stronger in the first quarter than over the rest of the year. So yes, he says a reason to be cautious about the data, like you say. Sorry, you were saying.
Yeah, no, I think that. So, we have to look ahead really to what's going to happen with inflation then, and then potentially, we're getting middle of the month UK data dump, aren't we, next week? So we do get inflation, we get jobs data, and then retail sales. So yeah, I think those are going to be important going forward as GDP is obviously backward looking, and how high CPI goes, sort of 3-4% potentially into the summer, possibly, while wages and real wages are falling, possibly then unemployment's rising. So that is probably more key for the Bank of England than this week's GDP, I would say.
Sure. And we also saw Q1 GDP out of China. We saw growth yesterday of 5%. That, again, decent when we look at the situation in the Gulf and everything that's going on there. So, again, how much of a glitch this will be for the global economy and global growth is yet to be seen. But if China's anything to go by, and it's probably not, but to base all your bets on Chinese figures, we could get away with this one effectively, couldn't we, Mike, in terms of the damage it might do to global activity?
Yeah, for sure. And definitely equities are signifying that. Just look at the rallies we've seen in some of those most sensitive countries to higher oil, Japan, India, pretty much all of emerging and developed Asia Pac. So, it looks like things are going to work out just based on price action that way.
Mm.
And, as recently as yesterday, though, we had those headlines that, Europe was going to only had, 6 weeks of jet fuel left. So we'll see what updates we get there. But for the moment, if we can get oil to kind of settle down here and as well as nat gas, then, some of those predictions, I think, are going to be revised in a good way.
Sorry, I'll just quickly, what I was going to say is, we still have to get the engine moving again. We still have to get transportation go. If this is a more settled state, and we are going to see the opening of Hormuz, the Strait of Hormuz, and everything else, and some form of normality, we have to. And don't forget the damage that's been done to a lot of the oil-producing nations in the region as well, and the infrastructure that they need to rebuild. Yes, it's a great thing that we're seeing that happen, but the underlying picture might still be a bit worrying, Jamie.
Yeah, I think that's exactly it. Relief trade at the moment, and sort of spike on the news, and then a sort of realization that things will take some time, months, even years. I think some of the LNG, right, production that got taken out. So then we'll probably see some sort of reaction to that, you would think. I wanted to just ask about the sort of IEA, predictions and that kind of thing with the 6 weeks of jet fuel left in the EU, flight cancellations. I thought it was really interesting because if you listen to any of the sort of CEOs in charge of some of the European airlines, they weren't that worried, I don't think, because they had enough fuel and the government wasn't taking many precautions. Everybody wanted to get some sort of, snap sort of interesting headline or one-liner from the government about them, reacting and what emergency measures were they taking, and then they weren't taking any. So I think it's really interesting listening to the energy experts in this, and
Sure.
and this has been the worst ever, oil crisis in history. And yet, markets are where we are, just something I think maybe to bear in mind next time we have, something like this, maybe.
I think sensationalism is the way of the world at the moment. So, you have to put everything in perspective. Well, you should be putting things in perspective more so than some of the headline writers. I want to move on to the week ahead because we're coming to the end of the episode now. Key events then for next week. You've mentioned some of them, guys. US retail sales will be interesting. A flash reading for US retail sales. Simply to see where that household demand is stateside. We had PCE data out, I think it was last week. really. That I think we took a bit of a dip, but nothing. I don't think it was that serious, Mike. I can't remember. I haven't got the details to hand, but the PCE data didn't seem to be bad. But I mean, I think it was pretty much a middling sort of read across. But we have retail sales up next week. What may be more telling is what we get from the PMI data, both for the US, North America, and for the Euro area as well, which we'll see next week. I put global manufacturing PMI obviously because I think the energy component really is going to be quite important to see what manufacturers are thinking and their sort of sentiment. But we also have obviously Eurozone data as well, and that will be maybe quite telling. Although I think in volatile times, it's not particularly a reliable figure to, or reliable survey to look at, Mike.
Yeah, to touch on those, we got the PC inflation last week, but that was a February print, so wasn't all that timely. CPI was fine for March on the core reading. Obviously, headline took off, but I mean, with energy prices now coming down sharply, I mean, we could easily see a negative headline CPI print for April, depending on how things shake out, and that's very early to say. But yeah, next week, we'll get retail sales over here on Tuesday morning. Most indicators point to some pretty good numbers. B of A is quite upbeat. I mean, they're looking for a 1.8 print on the month over month, which is actually huge.
Okay.
And then the core control, which feeds over to the GDP print, 0.6%. So pretty robust either way. Of course, over here we have much larger tax refunds than normal, and those really get cranking up in March. So that could fuel some consumer spending. But then also, gas prices were higher, so that will in fact drive the number up a little bit potentially. Yeah. So we'll see how the breakout between gas and other discretionary items looks within that. So that'll be an interesting look at March consumer spending over here. It'll be one of the good looks at how the Q1 wrapped up, and with GDP over here, it looks like we'll still have a 1 or 2% Q1 real GDP number. But that's very volatile with all the goings on with trade. And then beyond that, like you said, we'll get those flash PMIs from S&P Global. So those are April reads, first clues on how the war kind of impacted thinking. Over here, we have already gotten some regional surveys, things like Empire, Philly Fed. And those have been actually somewhat upbeat in terms of new orders, CapEx intentions. So those are
particularly, wasn't it? I think yesterday.
Yeah, they can be pretty volatile, but that was pretty upbeat. At the same time, though, prices paid numbers and prices received were also reportedly elevated. So kind of a mixed bag in there. So I'll be interested to see how the final read on UMich sentiment comes out. We'll get that a week from today. Recall that it was a record low consumer sentiment number in the last week. So it's very ironic because it's the first time I'm pretty sure that record low consumer sentiment and now record high stock prices. So we'll see if that adjusts, but that's the reality we're in right now.
Yeah, very much so. Just a note here from Danske on the Eurozone composite PMIs. They say, especially in Europe, we expect to see a sharp decline in manufacturing due to higher energy prices, and the price components could give some important clues about whether energy costs are filtering through to other prices. Also said, note that PMIs can be more difficult to interpret in times of high volatility, however. So that's a note from Danske there. We've touched on this before, Jamie. You got UK inflation data this week, alongside a labour report and retail sales. Any views on what to expect from inflation? I've got a note here before you start. TD Securities expects inflation to jump up to 3.3% annually. Again, against the Bank of England, it was looking for 3.3 as well. With energy being the main driver, it says core CPI is likely to remain at 3.2 year over year, with neither core goods nor services inflation delivering a meaningful shift. Any views on what to expect from inflation?
Yeah, 3.5%. I think we're going to peak at around that, maybe possibly, high threes by all accounts. But as I sort of said before, it's second round effects, isn't it? Is key, I guess, for every central bank, including the Bank of England, no doubt. But potentially UK sort of less exposed slightly to that and those inflationary effects because of increasing an increasing output gap and then sort of weaker pricing power. So yeah, we'll see. Ignore the headline, of course. What's the core? And I think it's interesting, again, Bank of England speakers coming out, before at the start they were very hawkish and now they seem to have reined it in by all accounts. So,
You said you've got to be active either way. You could not hike, you could cut, or you could stay on hold.
Excellent.
So,
Yes.
Yeah.
Thank you for that.
Nailing that down.
Yes. So, but yeah, we'll get a load of data and retail sales as well, right, on Friday, along with the jobs data as well. So, yeah, I think they're pretty much now down to one hike, maybe. I think priced in, and
Yes.
even that I think will be interesting whether they just hold on again through this period and even through the summer.
There's a tight committee at the moment in terms of it's very split between
very divided. Yeah, you're right.
In that sense. I mean, the TD Security says NBC contracts are currently pricing a full 25 basis points of rate cut hikes only by September meeting and then cumulative 35 basis points of hikes for the year. This seems more reasonable to us than pricing at the peak of the crisis. Again, and we have to see what that bleed through into the basket of goods is going to. I think food inflation is one to watch because that will take extraneous, I think that's the word, effect on the basket in terms of that's already at a level, and even with the relatively small period of time that we've had this crisis, that could put further pressure on upside food prices because of what it's used for, the energy, the oil's used for in terms of fertilizer and timing of the year that's all come through. There's loads of things to impute into all this, so it's quite interesting. We want to wrap it up, so I want to quickly go through what else we have. Japan's CPI, another interesting print, really. You got Japan headline inflation likely moderated, says HSBC, to 1.2% annually. Fuel subsidies capped pump prices despite higher global costs. German PPI will also be interesting for March because, as I discussed, I think last week with some guests, PPI inflation will now be a bit more telling and a bit more interesting to look at than it maybe normally is, because it's going to be that pipeline inflation that we're looking at, factory gate price growth, and to see how much inflation is coming down the line. Mike, would you pay a little bit more attention to PPI data in the next couple, at least for the next couple of months anyway?
I don't know. I mean, I think the PPI is going to be interesting just from the perspective of wholesale margins, because we have seen, I think, in the most recent couple of reports, margins suggesting to being compressed a little bit. So we'll see how that goes through. If wholesalers are willing to eat more of the cost here on the upside, that could be a net positive for consumers. But there's just a lot of noise in that. So I don't know. I think I would say the upshot there is to just take everything a little bit bigger picture with that, not get caught up in any one single data point.
Very, very good.
We do have the Walsh Senate hearing as well, right?
Yes, we do. Is that since going ahead? I know the Democrats are trying to delay it.
Yes. My question to you, actually, was it definitely going to happen or not on Tuesday? We're not sure yet, are we?
No, I don't think we are. Mike, do you have any? You're not enlightened on that at all, are you?
Yeah, we've had some moving headlines on that. The Democrats are looking to delay that, but I don't know. It may be one of those things where there's some grandstanding there, but it may ultimately just get done. Right. So yeah, either way.
Is it quite as straightforward as we think? Is this Tillis is the block at the moment? Is that right?
Yeah, but I think we've heard some things just recently where he's been a little more flexible on that. And gosh, I've had some. I heard one thing about that being able to go through on potentially without his support. So ultimately, the market seems to be getting past that. But yeah, I expect that to go through. And either way, the futures market just has nothing doing in terms of the Fed for the next several months.
I think even FX options over Wednesday, whatever, not moving either. So yeah, like you say, a bit of a non-event probably.
Interesting. All right, listen, we're at the end of we've gone over, but happily so, because it's been an interesting conversation. I'd like to thank my two guests. Mike Zaccardi, thank you very much for your participation.
Thank you.
And also to Jamie Dutta. Jamie of PIQ, how are you? Well, thank you very much.
Thank you, Harry. Always a pleasure being on.
Brilliant. Thank you to all our listeners. You can replay this from the start on our social media platforms or the podcast platforms out there. And obviously you'll get snippets across our socials during the week as well. But thank you, everyone, for listening. Again, with all the moving headlines, if you want to listen in live up to the second, liveswalk.com, please feel free to take out a trial and see if it's something that may help your trading, investing day. And we'll be back for another episode next week. So thank you, everyone, and have a safe and nice weekend. Thanks for tuning into the Live Squawk podcast. Your edge in the market starts here. Subscribe now.